Hello, welcome back. As the stock market is getting completely demolished these days, I wanted to make a video and examine 10 very well known tech companies and kinda discover which ones are a potentially interesting purchase for our money here and which ones are worthwhile investing in. And not just because everything is down, it deserves purchasing from us. We need to be finding the companies that are actually worth our money and that we can understand based on a lot of different metrics. But in this situation, I'm going to examine very concrete things. It's basically the free cash flow that the company makes, the revenue, and the net income. Revenue is a metric of the sales of the company, how much they can sell. Net income is the profit after all expenses are deducted. And free cash flow is the operating income minus capital expenditures, which shows the amount of money the company generates that they can use for paying dividends, buying other companies, things of that sort. So we're gonna start off with Meta Platforms or Facebook, which is currently at $187. And I'm gonna be using my stock evaluation tool, which is an exclusive tool that I have created for this channel, Investors Heaven. And this tool, let me explain how it works quickly. It has some data here, the revenue, net income, and free cash flow, and their respective growth and margins. Apart from the revenue, doesn't have a margin here, it's just revenue. Net income margin, for example, is the ratio between net income and revenue. And so we get a percentage of like 40% here. And this means that net income is 40% of our revenue here. It's 16 billion out of 40, which is 40% about. The free cash flow margin is the same thing, but with net income. It's free cash flow divided by net income. And the reason we're using this net income and this kind of free cash flow margin here is we want to correlate free cash flow with net income, because a company can make free cash flow with all sorts of different ways. Like, for example, they can have depreciation, and this depreciation is added back to the cash flow statement as cash flow, as free cash flow. And the same thing happens with stock-based compensation, because it's also added at the cash flow statement as a positive value. And so this can really skew your expected free cash flow from the company. And this is why we correlate it with net income, because net income is the actual profit that the company makes, excluding everything like taxes, expenses, everything, cost of goods. It's the bottom line, pretty much, what the company makes in real profit. And so this is why we correlate the two, and we get a better figure than actually just using free cash flow. And so we start with revenue, we move on to net income, and then we correlate net income to free cash flow, and then this helps us make our projections here. So let's start with our projections for Meta Platforms, is the first company that we're examining here. And we have a very handy table over here on the left of my screen, which shows us the revenue growth in percentages, net income margin, and free cash flow margin for the 5 last years, the 3 last years, and the last year. These are the averages. And so we can use this to calculate projections, and this is our low estimate, our medium, and high over here. And this is basically our lowest confidence one. So this is where we are very conservative. This is where we are less conservative, almost like an average. And high is going to be where we are most aggressive. And so looking at these values, a conservative low estimate can be something like, let's say 25, which is less than all of these. And a medium one can be 28, which is the 3-year average, and a high one could be potentially 33. And so you can obviously play with these values when you get a hand on the tool. At some point I will actually release it for use for subscribers. And net income margin here, you will see that this is sitting at 34, 31, and 33. And so we can do something like 30, 32, and 34 here, I think makes sense. The free cash flow margin, again, we're going to be using these average metrics, and we're going to go with something like 90, let's say 93, and 96 are high. And regardless of that being high, we still want to be relatively conservative, and it's a good idea to be less than the best that we have ever seen, just to be still having a margin of safety. It's a good thing. So 13% is the annual return that I'm going to be using throughout this, just because we want to be making about 13% at least. If you buy an S&P 500 ETF, you're normally making about 10% a year. So we need to be making more than that because we're investing in single stocks, and 13% is what makes sense here, at least. you can again play with these values. So I'm gonna hit calculate here, and you'll see that we're getting our estimates for meta platforms. Based on these values here and these projections, we're getting a low max price to pay today of $505, and a medium of 621 and high of 816. And that actually mentions, this is what it's about, is about the price that the max price that we should be willing to pay today in order to achieve this kind of projections here and make 13% a year on our investment. And for these projections, the medium ones, this is the value, up to $620 today, and for the high ones up to $816 today. And again, some of these metrics may be a little bit too optimistic. You may want to go a little bit lower, but this kind of gives you an idea of how we would project the stock price to pay today in order to achieve this kind of result in the future. And so it looks like, based on the current projections here, Facebook is sitting currently at $187. So any price here is awesome. It's much, much lower than we would expect and would want to buy. So it's a certain buy based on this model here. The next company we're going to examine is going to be Apple, and this is AAPL. So let's load Apple here. So this tool is fetching the market data. This takes a few seconds just to fetch the data and analyze. And so now it loads Apple here, and we can see the estimates for Apple and the actual data. And you will see that Apple has been, generally speaking, growing very well as well, with a few years of negative growth, really. It's not negativity, it's about the growth, really. And again, we have the estimates here and the averages of, these are not estimates, these are averages actually. And the 5-year, 3-year, and last year as we examine, I'm not gonna tell you again what it is. So we're gonna go with, let's say 10%. The medium one is gonna be, let's go 12, and the high one 15. The net income margin based on this, again, let's go 20, 22, and 24 over here. And the free cash flow margin, we're gonna go 95, 100, and 105. And the annual return is always going to be 13 in this example, in this video. And calculate. And we're seeing that for Apple, things are a little bit different here. So Apple currently sitting at $159, and all of our estimates here, all of our projections seem to be pointing that the price of the stock is still relatively expensive to, in regards to the revenue and the net income and the free cash flow of the company. So this points to Apple not being the best investment for our money at its current price, because that's key. If it goes below, like maybe here, like below 110, or below 100, then it becomes a very, very interesting purchase based on these metrics again. You could go more confident and justify it, but with these values that we examine here, which I think make a lot of sense based on what we have seen on the averages, this is what we're getting for Apple. All right, so the next company that we're going to examine is the third one, is going to be Microsoft. And let me find it here, Microsoft. Let's load Microsoft. It's gonna fetch the market data again. It takes a few seconds. There's a lot of data that the tool actually gets and analyzes in the backend. And again, we are getting the company's data here, the averages of the company, and you'll see here we're looking at probably a 14, 15, and 16 is what we want to be using here. A net income margin of, let's go 25, 28, and 30 here. The free cash flow margin, I'm gonna go 90, 95. Although the 5-year average has been better, and this is why you can use these averages. This kind of tell you a story of the company. This shows slowing free cash flow margins for the company. So they're not making as much cash flow as they were making in the previous 5 years in total, when you actually compare it to the 3-year average or the last year. And if you want to get even more data, this is why I have added a table here, so you can quickly see that it used to be higher here, the free cash flow margin, as you can see, and then it starts dropping a little bit. Very, very useful information for examining what kind of values to use here. So I probably want to go a little bit more conservative. You see the idea. I now discovered that the company seems to be having shrinking free cash flow margins, so I'm gonna go less here. I'm gonna go 80, 85, and 90. Gonna be more conservative because that's what I'm seeing on the data. And the annual return, 13, 13, and 13, and I'm gonna calculate. And you see again, we're looking at a company that is an awesome company, Microsoft, but it's overvalued based on based on what we're seeing in terms of the company's revenues and margins. And so right now, the company is almost double as much as what we want to pay. And again, it's a fantastic company. I love Microsoft, but not at this price. So that's the point of this exercise, really. So next up, Amazon. Amazon is going to be our next one, and we're gonna load this company. Hope you get the idea here. It's pretty simple. The tool is pretty simple to use, I believe. And we're gonna load Amazon here. As you can see, we're looking at Amazon, which is at $2,700 almost. And again, we're gonna use these values. The last year were 20%, so suppressing revenue growth in the last year. We can kind of see that here, 21%. It used to be 37 in 2020. So there's a little bit of a suppression here. That's normal for companies. And I'm gonna go, let's go 20, 23, and 26 here. The net income margin is rather low here. We're gonna go 3, 4, and 5. The free cash flow margin, we have negative free cash flow margin actually. And now this is something that you need to bear in mind and very, very important to understand. Companies like Amazon can have negative free cash flow in some years, but this happens on purpose because Amazon is spending tons of money in expanding actually. And so this means that they have capital expenditures. And what is free cash flow? It's operating income minus capital expenditures. So if the company is spending $50 billion for capital expenditures, which is in fact the case with Amazon, this skews the data for the last year because they spent a lot of money. And so you can use the previous years and you can use these averages and kind of exclude this one. But this is where the tool kind of shows you what's happening, and then you can actually use our financial statements here and see exactly what is happening. That's a different video actually. But you can see that these kinds of averages can tell you what is happening within the company, and they are very, very helpful in determining how to proceed with your estimates. So we want to exclude this one pretty much. And I'm going to go with a free cash flow margin of 95, 100, and 105 here, which based on what the company has been doing may actually even be conservative. So that's good. 13%, 13, and 13, that doesn't change. And we're going to calculate. And we're getting that Amazon's projection results are still pointing to a company that is pretty overvalued based on what we're getting here. Again, the company is fantastic, but people seem to have been paying a lot. And so do we really want to get into that? Well, you can obviously play with that and justify it, but for me, I always want to have a margin of safety and get things cheap. And even though I love Amazon and I have shopped so many things, I have bought too many things from Amazon, I want to buy the stock at a cheaper price. And if it drops at some point, then we can revisit. But I think that if we can use our money in better companies, not in better companies, in better stocks, in cheaper stocks really, not even better, then why not? And just wait for an opportunity with Amazon in this case. Which again, it's a fantastic company, don't get me wrong. But there's always a price for everything. That's the point. Google is going to be our next one. Our fifth company that we're going to examine in this video is going to be Google. And the tool is loading the data for Google here. Okay, Google is taking a little while. So yeah, our data for Google do take a little while. I'm not sure why. Yeah, that took a little while. And so Alphabet here, Google, $2,500. And you will see here that our averages are sitting at 23, 24, 41 here. So we're going to go 20, let's go 23 and 25 here, be a little bit conservative. We don't want to use 41, it's too much for our projections. Net income margin, we're gonna go, and probably the most important one to be conservative is revenue growth, really, because net income margins and free cash flow margins tend to be similar or approximately the same, very, very similar, really, not the same, most years, at least for these big tech companies and generally speaking, the big companies. The net income margin here that we're going to go with is going to be, let's go with 20, 22, and 25 here. Free cash flow margin, you see again, same story with Google, it's decreasing free cash flow margins here. And although last year it was 106%, so we're still going to go with, let's say 90, 95, and 100 here. And annual return of 13, 13, 13, that doesn't change again. and we calculate, and we're getting that Google, you may not have expected that based on the current price, but Google is actually at a good price to purchase today. And you will see here that based on these estimates, our low maximum price to pay for our low estimates is about $4,400, and we're sitting at $2,500. So you are seeing here that Google seems to be an interesting target for our money here, and a company that may be worth our investing. So the next one is going to be Nvidia. Nvidia is our next company, NVDA. We're going to be loading the data for the company here. And I'm doing all this in real time so that you can see how the tool works pretty much. And again, we have the data for Nvidia sitting at $213. And we're gonna go with, let's go with 28, 30, and 32 here. Net income margin of 28, 30, and 32 again, I think makes sense. And our free cash flow margin, you see all of those have suppressing revenues. Suppressing free cash flow margins over here. And you will see here that we're gonna go with 95, 100, and 105, 13, 13, and 13 is what I'm going to use. And we can calculate. And see that in the case of Nvidia, we are actually beyond where we'd want to be. So our highest estimates here, actually even our highest ones are below our current price. So this seems to be an expensive stock for us to buy. A fantastic company, an expensive stock, I'll probably pass in that case. It's always a matter of your decision, of course, but I'm telling you what I would do based on the data that I'm seeing, because I really love data, and I don't really make many decisions without consulting data, and this is why I made the tool, because you can love a company, you can love a stock, but at the very end, everything is about data, and so this is why it really pays to have an analysis of all these companies. It really helps with determining what's worthwhile buying and what's worthwhile waiting for. Because all of these companies, I'd love to have them in my portfolio, all of those, but I want to get them at a good price, and this is what our tool tells us here. What's the price to pay? So Alibaba is the next one, and we're gonna go with, look at this revenue growth here. It has been having great revenue growth, but we have here that it's going to be suppressed a little bit potentially. So we're going to go conservative here. We're gonna go 20, 23, and 25. Now, someone can say that this is not very conservative, but remember, this is about the next 5 years, not 10 years, so we can be a little bit more aggressive. And because it's closer into the future, we're not talking about much later into the future. So which case we would go even more conservative. And you can always go even more conservative yourself. You can go 10% and 12% and 14%. And this is what I'm also doing in other videos that I'm making, or my personal estimates really. But frankly, I think this is very achievable for this company, and so this is why I'm using these numbers, because I want to be closer to reality and not so much extremely conservative just for the sake of being extremely conservative, if you know what I mean. And so the net income margin here that I'm going to go with is going to be 20, 22, and 24. The free cash flow margin, that's awesome margins here. So I'm going to go 100 and 105 and 110, 13, 13, and 13. And we're going to calculate, and we're seeing that for Alibaba, as you would kind of expect, we're way below our estimates here. So our current price is sitting at less than $100, and our lowest estimates are sitting at 246 for the current price to pay for the stock today. So that's looking like a great purchase, and I've made many videos about it, and I do think that it is a great purchase, and that's why I have it in my portfolio personally. Cisco is going to be the next one that we're going to examine, and that's two more remaining after Cisco. So Cisco here, you will see that the revenue growth is terrible. They haven't been growing greatly. And this is why this kind of tool really helps, because now we can use like 0, 1, and 2, because we know that the company right now is at basically zero growth stage, and it's just a value company. And we should be treating it like that when we're estimating our free cash flow growth into the future. And so the net income margins here, relatively low as well. Let's go like 15, 17, and 19. Free cash flow margin, this is the odd one out. That's not normal here. But normally speaking, we're looking at a company that has probably 100 and 105 and 110 here, and an annual return of 13, 13, and 13. And calculate here. And again, we're looking at a company that's expensive to buy today. As you can see, all of these are red for all of these scenarios here. And Cisco doesn't look like it's cheap purchase for our money here. So we're going to avoid. Broadcom, or AVGO, is going to be our next one, our 9th stock that we have examined in this video. And this one, you'll see here, our revenue growth that we can use is something like 8, 10, and 12. Not very impressive, but still growing a little bit. And for net income margin, we had some suppressing margins in the last 3 years, so I'm gonna go with 14, 15, and 16 here. Free cash flow margin, again, this is a little bit of the odd one. Oh, actually, it's not the odd one. They have a lot of free cash flow over here in terms of net income ratio. Okay, they have quite significant margins here. So I'm gonna go higher. They did have a 67 here, but I'm still gonna go, let's go 130, 140, and 150, be more aggressive with this one. 13, 13, and 13. Calculate. And still we're below where we'd want to be in order to buy it. So it's still expensive at 570 bucks, which is sitting at today. So we're going to pass. Oracle is going to be our last stock for this video. And Oracle, another very, very well-known tech company. Let's see how that can treat us. And this, you can see that all of these projections are very, very quickly to make, very, very quick to make. And I can very, very quickly establish whether I'd like to buy the company. Once I examine the company beforehand and I know of other metrics, then I can use this tool and see what am I willing to pay. 0, 1, and 2, the company has very limited growth here, as you can see. Let's go 20, 22, and 24. Free cash flow margins, we're going to use 100, 105, and 110, and 13, 13, 13. And I'm going to calculate here. And again, we're looking at Oracle being a little bit overpriced here, even on our highest estimates here. And so sitting at $74 and currently being at 58 is not good enough. And yeah, it doesn't make sense to even probably try 3. This was like a last year thing. Yeah, previous years. Actually, they did have a 5, but you can't expect that for the next 5 years. You can probably expect something like 1% on average, or maybe 2%, something of that sort. So we have examined 10 companies, 10 of the very, very well-known companies in the stock market, tech companies. And so hopefully that kind of gives you an idea of how to evaluate the stocks. And, this tool can really, really help. Again, as I've mentioned, at some point I'm going to be making it available to the public. But right now I'm still working on it. There are other modules that I'm working with. It's a very, very interesting project for me. I love working on these things. I love analysis of stocks. And I'm gonna be letting you know of more once once I'm done with it. So hope you enjoyed the video. Hope you liked what you saw here. And if you did like it, and if it does help you a little bit, please give it a like, a thumbs up, because that really, really helps, and we can bring this content to more people and grow the community here. And you may want to become a subscriber if you are not one, because you may be one of the first people to join the tool and use it. And this can really, really help with your investing. It can help you save a tremendous amount of time, this tool. I mean, it definitely has helped me. And so thank you for watching this one. If you did enjoy this, let me know which other company you'd like me to examine with this tool. And in the meantime, take a look at this video that I made about Facebook, Meta platforms, and it's dedicated, in which I'm also examining some different metrics about Facebook, and also using this tool as well, about among other information. And I'll see you in the next video. Thank you for watching this one, and it was awesome having you around. Thank you guys. Bye bye.